Good afternoon, everyone. It's great to be back here. Thank you for joining our webinars. If you've been to past webinars, thank you for joining those. If you were here last week with Mike, thank you for being patient with us. Sorry that I couldn't make it. There was a huge storm in Colorado where I'm located, and um, I was dealing with the consequences of that. So thank you so much for being here today. So before we get started, I'm going to go ahead and do some housekeeping items, and then Mike will jump in and give our presentation here today. So first and foremost, if you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. You will need to answer the polls as they pop up on your screen. If you have any issue with that, just send me a message. I'll help you get it sorted out. But you do have to answer all 3 poll questions today in order to receive that CPE credit. You also will need to fill out the survey at the end of this webinar. It will pop up for you automatically as you're exiting. It will also be emailed to you in 24 hours. Give us a couple business days to get that back to you, and we will get you your CPE credit if you participate in this way. Couple other important things to note here. As we're going along, if you have questions, please reach out and ask. We're going to do our best to address your questions at the end of this webinar or following up with you via email. You can use the Q&A button. If you just move your mouse around, you'll see a little Q&A button. You can use that. Send your question over anytime. And again, we're going to do our best to answer those at the end of this webinar. Once we get the ball rolling here a little bit, I'm also going to be sending out today's slides and handouts in the chat feature. They are also uploaded to Zoom directly, and I will be emailing them to you in 24 hours as well. And a little bit of a plug here for our pre-recorded webinars. We do offer pre-recorded webinars that do offer CPE. They come along with a membership in our Salt Vault. You can also get them as a standalone product. If you have more questions about that, please reach out. I'm happy to share that information with you. And a couple quick introductions here. First, for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out. We'd love to work with you as well. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded. He has helped thousands of companies of all sizes and in all industries, and is especially well known for his work in the e-commerce industry. So Mike, if you want to take it from here, let's go ahead and get started.
Thanks very much, Ellie. Welcome back. Thanks, everyone, for joining us today. We've got a lot of information to cover. Some of the topics, we're going to go over some use tax basics. We're going to actually talk about what use tax is. We're going to talk about the history of use tax, how it came about, how it's evolved. We're going to talk about the vendor's use tax or seller's use tax or retailer's use tax that some states have. And then we're going to talk about the consumer use tax, which is what most people are familiar with. And then we're going to touch on some common problem areas. So a lot of information to cover today. And Ellie, why don't we go to the first poll question?
Absolutely. A real big quiz for you up here on the screen right now. Take your time, really think about the answer. But did you attend last week's webinar? Your choices are yes, or you did not make it. A quick reminder, we do have to have record of these polls in order to award you CPE credit. So please send me a message if you're not seeing this right now. Mike, it looks like answers are still rolling in here. Let's give everyone a few more seconds and then close it out and we can move forward.
Okay. I'm going to start moving on here. We are all here today to talk about use tax. And use tax is a tax on the storage, use, or consumption of a taxable product or service. And it's what they call complementary or compensating. And it's compensating or complementary to the sales tax, which basically means that you only pay the use tax if a sales tax is not paid. Generally, It's a huge problem when it comes to audits. It's either the first or second largest cause of large assessments. The other one is exemption certificates. So if you have a responsibility to collect exemption certificates, that's usually your number one, followed closely by use tax. And if you don't have a responsibility to collect exemption certificates, then use tax is often going to be the leading cause for large assessments. So very, very important that we understand use tax so that we can avoid some of these large assessments if we're audited. Seller may have a responsibility to collect a use tax. That's when we're talking about the vendor's use tax or seller's use tax or retailer's use tax. And if the use tax is or sales tax is not collected by the seller, one or the other, the purchaser is supposed to self-assess and remit it directly to the state. So, a real brief history of use tax. First modern day sales taxes were implemented in the 1930s. And at that time, it was widely believed that interstate commerce could not be taxed directly. Even the states did not believe that interstate commerce could not be taxed directly. So in-state companies were all of a sudden at a disadvantage because you had companies setting up on the borders of these states that were siphoning business away from the in-state companies. Let's use the Texas-Oklahoma border. You could have two stores, maybe they're less than half a mile apart, one in Texas, one in Oklahoma. And if Texas had the sales tax and Oklahoma did not have the sales tax, then people, why would you not go to Oklahoma to buy those items? So, in order to level the playing field, the states came up with this use tax, and it's a complementary tax for the storage, use, or consumption in the state. So it's no longer a tax on the transaction, it's a tax on how it's being used. Is it being stored, used, or consumed inside the state? So some people say it's semantics, but it actually makes a difference. Now, here's the kicker. Sellers, if they had a link or connection with the state that we call nexus, you still had to collect this tax. So whether you call it a sales tax or you call it a use tax, the seller still had a responsibility to collect it. Now, today, people think there are actually two different taxes. They think that, there's a consumer use tax and then a seller's use tax or retailer's use tax or renter's use tax. And that's just not true. It's only one tax, it's the use tax. And the difference is who's required to remit it to the state. If it's a seller, use tax, and the seller's required to collect it and remit it to the state. If it's a consumer use tax, then the consumer is required to collect and remit it to the state. And by the way, when we say consumer, we're not talking about retail individuals. Businesses can also be consumers of an item. So it's the consumers. Some states even nowadays make a distinction between a consumer use tax and a seller's use tax. So technically speaking, if we look at this historically, only sales that never crossed a state line have been subject to sales tax. And that's because it was widely believed that, you couldn't tax interstate commerce directly. So only transactions that happened totally within a state were subject to the sales tax. So sales that did cross a state line, they've been subject to use tax. Now, in the 1950s, we started seeing, states change their thinking on whether they could tax interstate commerce directly. And there were a number of cases out there. And in 1977, the U.S. Supreme Court in Complete Auto Transit, they didn't come up with anything new, but they sort of cobbled together all of their other decisions since the 1950s. And they said, yes, interstate commerce can be taxed directly so long as it meets a four-pronged test. And it's a pretty easy four-pronged test to make, to meet. And at that point, we started to see a blurring of the lines between sales and use taxes. And some states did away with the seller's use tax. They just lumped, like Pennsylvania will say sales use and um, oh, the hotel occupancy tax. That's what you're registering for. So they don't make a distinction. Other states, like a California or Virginia or an Illinois or Missouri, still made a difference. Then we had, there were lots of states actually, Colorado, it was another one. Then we have Wayfair. And that really broke the model because many states have come out since Wayfair and they said if you have an economic nexus, we consider that to be significant nexus and really the same as having a physical location in our state. So if you have an economic nexus in some states, you no longer collect the seller's use tax and you have to start collecting the sales tax. We'll go through a couple of examples of that, but not all states. We'll go through an example of that also because some states still make a distinction between a seller's use tax and a sales tax. Most people don't care. It doesn't make any difference to them. It doesn't make any difference to a lot of sellers. I mean, are you collecting a sales tax or are you collecting a use tax? I mean, you're collecting a tax. Unless you're a tax person, it really doesn't make a difference. If I'm paying something, who cares what you call it? I'm still paying a tax. But it can make a huge difference. And we're going to go through some examples. Can make a difference in which registrations you're doing, which rates you actually charge, and what returns you're going to file and what the filing requirements actually are. The forms when you're doing the returns can also be different. So let's look at the Oklahoma vendor's use tax. So this is a state where they've kept a distinction between the sales tax and what they're calling the vendor's use tax. It's a seller's use tax, retailer's use tax. Different states call it different things. Oklahoma calls it the vendor's use tax. So if you're a true remote seller, you're required or you're supposed to register for the vendor's use tax. Pretty easy process. But if you have an in-state physical presence, you're required to register for sales tax. So a pure economic nexus, vendor's use tax, in-state physical presence, sales tax. Now, here's why this makes such a big difference. If you have to register for sales tax, you generally have to register with the Oklahoma Secretary of State, and that's going to be $300 plus fees for other required documents. It's going to require a registered agent. Fees for that range from $99 to $350. It's going to require an annual franchise tax return. By the way, you have to renew your registration with the Oklahoma Secretary of State every year. So that's going to be an issue, and you pay money every year to get it renewed. Also, when you're registering for the sales tax with the Secretary of State registration, now you're generally subject to income tax. And the Department of Revenue, or whatever their equivalent is in Oklahoma, they're going to charge you $25 for the privilege of signing up for the sales tax. That's a lot of fees there, especially when you consider that if you sign up for the vendor's use tax, you have none of those requirements, none of them at all. It's free to sign up for. You don't have to mess with the Secretary of State, the income tax. It's just a heck of a lot cheaper, a lot less hoops to jump through. Now, there are some software companies out there, and I don't know if they still have a problem. I think that they do, but let's throw the name out there. TaxJar. I call TaxJar. For those of you who have listened to me before, you know I have a love-hate relationship with the software companies. And I break them down into two tiers. You have your top tier companies, which that's a little bit misleading. I think that software is a necessary evil, but I have my misgivings about all software. But then you have your second tier companies. The first tier companies are companies that can do everything you need them to do. The second tier companies are the ones that can't. And Taxjar is what I consider to be a second tier company. At one point, they were telling for some reason they couldn't file a vendor's use tax return. So they told all of their customers, software companies actually have customers rather than clients, but they told all their customers that they needed to change the way that they were registered. They made them all go back out there and register for the sales tax, not telling them any of this other information. Now, sometimes it didn't pop up right away, but at some point the state realizes, hey, you're registered for sales tax and you're not doing all these other things. So that's a big problem there. They didn't tell anyone that they could be subject to all of this other stuff. Nowadays, I still don't, since they've been purchased by Stripe, I don't know if they have fixed this, but they've got other problems. So I still lump them in as a second tier company. They can't file any of the Colorado local jurisdictions. So I don't know what else they can't file, but if you're going to be using them, or if you are using them, you got to make sure that they're actually filing for you correctly. So this is one area where there's a distinction between the sales and use tax, and how you register, what you're filing is going to make a difference. Another one is Illinois. Now, I said this, the complete auto transit, four-prong test was pretty easy to pass. Well, the politicians up in Illinois have figured out a way to really mess it up. So remote sellers are required to register for the retailer's occupation tax. Retailer's occupation is what Illinois calls their sales tax. Prior to economic nexus, you were registering for the retailer's use tax. But now you're signing up for the retailer's occupation tax. And if you have no other connections with the state of Illinois, you've got to do it destination based. In other words, where you're shipping it to. When you're doing destination based, there are almost 4,000 local jurisdictions that you got to figure out the rates for. You've got to figure out how to do the returns. We've had to file hire 3 or 4 extra people just to file the Illinois returns for our clients, because it's that much more manually intensive. 4,000 local jurisdictions. It's a nightmare. Now, if you're a seller shipping from Illinois, you're required to register for the retailer's occupation tax, same as the remote seller. But now, since you're shipping from Illinois, you have a location in Illinois from which you ship, you are origin based. So remember I said that 4-prong test? Well, this is discriminatory, which is one of the 4 prongs. You're discriminating against interstate commerce. If I'm outside the state with no connections to the state whatsoever, I've got all of this extra work to do. If I'm inside the state, shipping from inside the state, then it's pretty easy. So I've been saying that there's going to be a challenge to this. I've also been saying that even though I think this is a constitutional issue, it's a big problem. Illinois is very aggressive. And, unless you plan on fighting this in the courts, which gets pretty expensive, to just go ahead and try to comply with what they're doing. And the fix for this is fairly easy, and states will sometimes try to go back retroactively in order to, once they have to fix this. So Uh, I would still suggest continue doing this, even if this is challenged. And right now, there is a challenge. It's not to the Supreme Court yet, but I assume that it's going to make it to the Supreme Court because this is just wrong. But unfortunately, there's a lot in taxes that don't seem fair and aren't fair. But I think it's cheaper to comply than not comply. Now, this gets even more complicated because if you are a seller with a physical presence, but you're not making any deliveries from Illinois, then you get to register for the retailer's use tax, which is what remote sellers used to register for. So this gets totally confusing here. And if you're registered for the retailer's use tax, you have no obligation to collect any of the local rates in the state of Illinois. So what we tell our clients, especially if someone's going to be doing the returns themselves, is send someone into Illinois, create a physical nexus, have a salesperson go there a couple times a year. Yes, there's a cost to sending a salesperson in there, but now you get to be retailer's use tax, and you don't have to worry about collecting the 4,000 local jurisdictions, almost 4,000. So, and then having to do the returns and making sure all that money gets allocated to the right places. So that's a planning point. Send a salesperson or anybody that's going to be creating Nexus with Illinois and go ahead and then you can register for the Illinois uh, retailer's use tax rather than the retailer's occupation tax. All right, Ellie, why don't we go to the next poll question?
Absolutely. That poll question should be up on the screen right now. Just a quick true or false. The first modern day sales tax were implemented in the 1930s. And while everyone is answering this, I did get a question about the slides and the handouts. They were sent in the chat. After this poll question, I'll go ahead and send them again in case you missed them. But we will get those out. So thank you. Thank you for sending those. And Mike, most people are answering true right away. Why don't we give everyone just a couple more seconds and then we can close this out and move forward.
Okay, and that is the true answer. The first modern day sales taxes were actually introduced in the 1930s. There's some disputes as to which state was first, but they were introduced in the 1930s. So, all right, so let's start talking about the consumer use tax. It's still the same use tax, only some states identify it differently. And nowadays, most of us, when we think of a use tax, we think of this consumer use tax. Only exempt purchases are tax-free. If a seller does not charge you tax on a taxable sale, you're required to self-assess, accrue, and remit it to the state. And the key words there are a taxable sale. Sale may not be taxable. And if it's not taxable, then you don't have to self-assess and remit it to the state. So knowing taxability, what's taxable and what's not in your state, very, very important, not just when you're selling things, but when you're purchasing things also. This goes for individuals as well as businesses. Individuals are not audited, so this often goes unnoticed. This is one of the big reasons why the states made such a big push for Wayfair, because you had all of these consumers selling on or purchasing on Amazon, and the tax wasn't being collected. So they wanted to make sure that the marketplaces themselves started collecting these taxes. Now, since the individuals are not audited, that's starting to change a little bit because on the state income tax returns, many of the states have said, how much use tax do you owe? So the state income tax returns now require you to answer some questions about that use tax, but in many states they don't. So It's not a huge issue for individuals, but it is for companies. And as I mentioned earlier, it's either the number one or number two problem for most companies in audit. Um, so let's look at what auditors and use tax, how they interact. Because when an auditor comes out and they're performing an audit, they're looking not only at your sales to make sure that you collected tax on everything that you should have collected it on, that you charged the right rates, and that all of that tax was actually remitted to the state. They're also looking at your purchases because remember, we said it's not a tax-free purchase. If it's a taxable item, you're supposed to self-assess and remit it to the state yourself. So the auditors want to make sure that you're doing that. So, the auditor is looking, and this is how this is becoming a big issue in an audit, the number one or two issue, because purchases don't always do a great job. They usually don't do a great job in tracking what they're purchasing and making sure that the tax is paid. So the other thing is this is how many companies are found for audit. Because if you're not charging your customers tax and they get audited, the auditor is going to be looking at their purchases. And the auditors look at, their expenses, their fixed assets. So the auditor is spending a decent amount of time looking for use tax issues. They're also using it as a prospecting tool. And some states are more formal than others, but in all states, it becomes a prospecting tool. In Texas, a lead card has to be filled out for every unique invoice that doesn't have tax on it. When I say unique, if one company shows up 30 times in an audit, they have invoices, then you don't need 30 lead cards. Unique means just that one company. And just because you're on a lead card doesn't mean that you have a big deal. Maybe what you were purchasing or what you're selling is not taxable, or maybe what you're selling is you don't have nexus in the state. You're not required to collect it. But you're on a list. And the reason why that's a problem, most states, just about all states, have what they call discovery units. And a discovery unit, their primary function is to find new taxpayers, people who are outside the state that they think they should be paying that state's taxes. And they collecting and remitting that state's taxes. There are other ways that these discovery units can find you, but that's a really big way. That's probably the number one way that companies are found for audit if they're selling on a business-to-business basis. You're selling to individuals. Individuals don't get audited. So, the auditor's not seeing that. But a lot of companies that come to us and say, hey, we're under audit. And when we talk to the auditor, how were they found? Well, we audited one of your customers and lo and behold, you weren't charging tax. So that's how you were found. So expenses and fixed assets, you've got to be, the auditor is going to be looking at both of them. So you got to make sure that you're taking care of all of this. What's taxable, what's not, what were you charged tax on? And you need to self-assess whatever the differences were and remit it to the state directly. Now, here are some common problem areas. Now, software purchases. A lot of software companies tax this to one location or don't tax it at all. But you may be using it in multiple locations. So remember, a use tax is for the storage, use, or consumption. So if the tax is paid in one state, but it's being used in another, that's a problem. So a lot of times auditors are going to look for large software purchases. And if you have people in their state, then the software is not generally used at the corporate headquarters. It's generally used throughout the offices of the company. So software purchases. Now, A lot of times, some states have what's called a multiple points of use certificate. So if you give that to your seller, they don't charge you tax anywhere. They don't charge it just in the one state. They're relieved of having to charge you tax because you're telling them we're going to pay this as a use tax in all the states where we're using this software. So software purchases, big problem area. Services. This is a problem for a couple of reasons. Number one, multi-state providers, services are not taxed uniformly across the board. Some states tax a whole lot of services. Some states tax few services. I don't know of any states out there that tax zero services at this point. And, states are continuously adding more and more services that they tax every year. I mean, our economy has changed since it was back in the 1950s. Back then, we were more of a manufacturing economy. Now we're more of a service-based economy, and the states are going to continue to change to catch up so that they don't lose out on all of the tax revenue that they used to get when we were a manufacturing-based economy. So, number one, people may not be charging the tax. And if they're not charging you tax, again, that's not tax-free. That just means that you have a responsibility to self-assess and pay it where the services, benefit of the services being, each state's going to be different. Benefit of the services being received, where the service is actually being performed. So you have to know the taxability rules of the states where you're located. So in this day and age, even some smart accountants out there tell us, well, Mike, services aren't taxable. Well, they're not taxable by default. Like tangible personal property is usually taxable by default unless there's a specific exemption. Services, on the other hand, usually have to be specifically identified. But as I mentioned, I don't know of a state out there that doesn't identify at least some services that are going to be taxable. So the purchase of services, big problem area when it comes to use tax. Opening new locations. When you're opening a new location, you have a whole bunch of different types of purchases. And sometimes these purchases slip through the cracks. If you got any new construction going on, this can be a very common problem areas. And auditors look for this. They look for announcements. They go and check permits. Who's, got a new permit? Who's opening up a new location? Who's building a new building? And they target those types of things. So if you've got any of these activities going on, new construction, new locations, make sure that you're paying attention to your purchases, that you're either paying tax at the time of purchase, or that you're self-assessing and remitting it as a use tax. Now, if you're buying something for resale, obviously, then there's a resale exemption. You don't have to pay the tax. You don't have to pay a use tax. These are things that you're usually using or consuming in your business. So if you're using something in your own business, you generally don't get to buy that on a tax-free basis unless it's being used and consumed in the manufacturing process or something similar. And even then, each state has their own idea of what is considered part of the manufacturing process. So we've got to make sure that we understand the taxability when we're trying to figure out what we need to accrue for use tax. Renovations of existing locations. Again, a lot of purchases are made, and sometimes you need permits, and that's something that auditors are checking the states with. The permits often done through the state basis, sometimes the local basis, but auditors have access to these things. Manufacturers. And I mentioned that, manufacturers get to make a lot of tax-free purchases. Anything that's used or consumed in the manufacturing process, a manufacturer can usually buy on a tax-free basis. Now, that doesn't mean anything. And sometimes you have employees who think that everything a manufacturer buys is going to be tax exempt, and it's just not. Or sometimes a seller may think that everything a manufacturer buys is exempt, and it's not. I'm going to give you some really bad auditor humor here. We had a woman who thought she was doing a great job for a company. They were, purchasing through one office for the entire country, all of their different locations. And she thought that manufacturers purchased everything tax-free. So the auditor is going through all of their purchases, and he comes to me and he says, "Hey, Mike, I think we got a problem here. They're buying hundreds of thousands of dollars worth of toilet paper." Here's where the bad humor comes in. Yes, toilet paper is used and consumed, but not in the manufacturing process. So this had to be set up, and it was a big issue for them. I mean, tens of thousands of dollars of tax because someone thought they were doing their company a good job. Can you imagine having to go to your boss and say, "Hey, I short paid all these invoices, and because I thought I was saving us a whole lot of money, and now we have all of this tax that we weren't accounting for, plus all this penalty and interest, um, because it was actually taxable." And you got to tell them it's toilet paper. Very silly thing, I think, that to have to go to your boss and tell them we got a big issue. But it can happen on anything. It can happen to anybody, any company. So this is one of the common problem areas. And the definition of a manufacturing process looks different between the states. For example, a forklift may be exempt in a lot of states. In a state like Texas, it's generally not going to be. It's going to be looked at as intra-plant transport, and that's taxable. So if your vendor doesn't charge you sales tax because they think that, hey, manufacturers get to buy forklifts on a tax-free basis, you should be self-assessing and remitting the tax. Contractors, they're one of the groups out there that get this wrong more than other groups. So sometimes their projects are taxable, sometimes they're not, sometimes they're viewed as retailers. Very often they're viewed as the final consumer. Now, let's talk a little bit more about contractors. Actually, we're going to talk more about contractors, but first, let's service providers. Sometimes the products they purchase are eligible for resale, but more often than not, they're viewed as the final consumers. So you have to pay taxes that on a lot of the products that you use or consume in the service that you're providing. Now, an exception to this is if it's a taxable service, then you can often buy those products for resale. But if it's not a taxable service, someone's got to pay a tax on those items. So the service provider is viewed as the final consumer because they're using it to provide their service. Out-of-state purchases. You can buy something in one state, but when you carry it into a state, that state you're carrying it into can subject it to a use tax. Now, you can generally take a credit for tax legally paid to another jurisdiction. I say legally because if it wasn't actually due in that other state, you just paid it by mistake or on purpose because it was a lower rate. States will often not let you take a credit for it. It has to be legally due there in order to take a credit in most instances in this other state. Now, let's say I bought it in the state of Oklahoma, and I'm going to use it on a job in the state of Texas. And I purchased it in a low rate jurisdiction in Oklahoma, and I'm taking it to a higher rate jurisdiction in Texas. And what I need to do is I can take a credit for the tax I paid in Oklahoma if it was legally due, but now I have to pay a tax on the difference in value. The difference in rate. So if I paid 6% in Oklahoma and it's 8.25% here in Texas, then I have to pay 2.25% to the state of Texas because that 6% I get a credit for. Now, on the opposite, if you're going from a higher tax state, let's say you were going from Texas to Oklahoma, same numbers, um, now no additional tax is due to Oklahoma because when you get the credit from Texas, it pays everything off. Now, you don't get a refund, but you don't have to pay any additional tax to the state of Oklahoma. So these are just some of the problem areas. We're touching on the big ones. All right, so intercompany transfers. Now, these may be disregarded for income tax. That does not mean that they're disregarded for sales tax. And transactions between an owner and a parent entity can actually be taxable. And transactions between sister corporations can also be taxable. I was involved in an audit one time, and there was a company, they were headquartered in Minnesota, and they were moving some heavy earth moving equipment to Texas. They were working on a project here and they didn't think anything of it. And then they were audited here in Texas. Texas saw that they were moving equipment that, no tax had been paid on in Texas. And they set it up in the audit because, intercompany transfers can also be taxable events, something we have to keep our eyes open for. Mergers and acquisitions, different rules for different states. Definition of an occasional sale is different from state to state. And in some scenarios, it depends on whether the seller paid tax on the purchase. So again, when companies are doing due diligence, sales tax should be a big issue. And who's responsible if there is going to be any potential liability? And does it need to be cleaned up prior to the merger, or can it be cleaned up afterwards? A lot of times companies nowadays make the seller put money aside in an escrow account to be held for a certain period of time so that in case anything happens, it comes out of that account, or the purchaser can actually go and use it to clean up all of the messes. So generally, you're better off cleaning them up yourself because you care more about the money you have set aside rather than the purchaser. It's not their money. They're cleaning up these messes. They may not be as efficient as you. But if you're doing any mergers or acquisitions, very, very important to do sales tax due diligence. And even in contracts, in large contracts, someone from the sales tax department should be involved in reviewing the contracts to see what the contract implications are. All right, so now we're going to talk about the contractor issues. And with contractors, they can, it gets confusing because I can be incorporating tangible personal property into real property, and it doesn't become a part of the real property. Say a dishwasher, generally that's going to retain its characteristics of tangible personal property. So I can be installing tangible personal property and it not be an improvement to real property. But I can also be making installments. Say I'm putting in a door, and that's going to become a part of the real property. And real property is generally not going to be taxable. So improvements to real property, you're generally not going to tax. There's exceptions to every rule, but in general, you're not going to be charging tax to the property owner, who's going to be the contractor's customer. The contractor themselves is usually deemed the final consumer. And if you're the final consumer, then you need to either pay tax at the time of purchase, or you need to self-assess and remit it as a use tax. So very, very important knowing the taxability, knowing whether something's going to become a part of real property or not. So different states are going to treat these differently. Sometimes you can be a contractor and a manufacturer and a retailer or a retailer. So it can be different depending on how your contract is written. It can be different depending on who your customer is. It can be different depending on what's actually being installed. So if you're a contractor or manufacturer, or a retail contractor retailer, what's going to be the basis of your tax? Maybe it's the raw materials that you're using to create this tangible personal property that you are then going to uh, uh, install um, into a real property. Maybe you're a retailer and you're selling these items at retail and not doing installations sometimes. So maybe you're going to use the price that this would normally sell at retail. So lots and lots of questions. What's the basis of the tax? Are there different rules if I'm manufacturing the items I'm actually installing? Sometimes manufacturers lose uh, their ability to be treated as manufacturers when they're also acting as contractors. State of Texas is a perfect example there. So let's talk about the consumer use tax accrual process. It's very, very important. As we said, this is number one or number two reason for a large assessment. So you got to have a system in place. Now, different things you can do when you're putting a system in place. If you don't have a whole lot of invoices, if the number of invoices is manageable, you can review all the invoices. If you've got hundreds or thousands of purchases, sometimes that is just not a good amount. So maybe you review all invoices over a certain dollar amount. If you tried to do every invoice, it would be, unmanageable. Maybe you do a sample of the smaller invoices. You could have thousands of purchases for $1. Do you really want to review each purchase for $1? No. So maybe you do some sampling on smaller invoices. You also may want to target certain vendors. Some vendors get this wrong all the time. And if you've identified a vendor as getting it wrong all the time, then you'll want to make sure that you review all of the invoices from that specific vendor. You want to make sure you're reviewing all your fixed assets, review all expenses over a certain dollar amount, just, like we talked about, and then sample smaller expenses. So lots of ways to do this, but I strongly believe that you have to have some sort of process to account for this. The stakes are too high if you don't, if you're making a lot of purchases. Now, the consumer use tax accrual process, and we're going to continue here. There's a lot of software out there, and a lot of these software companies are going to tell you, hey, just use our software and you don't ever have to worry about use tax issues again. And that's usually one of the problems I have with software companies. It's the salespeople telling you you don't ever have to worry about anything again. If a salesperson ever tells you that, run, because it's usually not true. So there's a couple of different ways you can do this. You can use a manual approach where you're doing everything manually. You can use an automated approach like the software I was just talking about. You can use a blended approach, which is you're doing things manually, but using software to make your life easier, or you can outsource it to someone else totally. So like I said, despite what software companies tell you, their use tax software cannot do it all. And for most companies, you'd have to change the information you collect for your accounting process. You'd have to change it drastically in order for this software to even work for you. So as we mentioned earlier, manual approach can be okay with limited transactions. If you're going to be doing this on your own, I think the best way to do this is a blended approach, because this software, it does have some uses out there and it can make your job a lot easier, especially one of the better software companies I like out there right now is Tax, especially when it comes to use tax. So that's something that It can make your job a lot easier. It can make your people's jobs a lot easier, especially when there's a large number of transactions. They can also help with the taxability um, on the use tax side. So we suggest, as I mentioned, a blended approach if you're doing this on your own or outsourcing the process entirely to a third party. But you've got to do something because, like I said, the stakes are too high here. So the ideal person tasked with managing this project, they have to have a basic understanding of tax. They have to have access to a taxability matrix or taxability software, and they have to have their work spot checked from time to time because the best process that you can design is only good if your people are actually following that process. And what we have found is some of the companies with some of the best processes and policies out there, their people aren't doing it. They think they're protected. All of a sudden, they get audited and they're blind to the potential liability because they think they were covered. So, perfection is not the goal. You're never going to prevent 100% of potential use tax liability. I just don't think that's a realistic goal. At some point in the future, maybe it could be, but for most companies, the limitations of the accounting process and the software limitations are generally going to make it cost prohibitive. So we want to prevent the majority of the exposure, but not 100%. As I mentioned earlier, do we really want to be, reviewing 1,000 invoices at $1? No, we're going to do some sampling. Now, auditors may come in and they may do their sampling and you may miss some of the things, but perfection is not the goal. You'll actually spend more money trying to be perfect than any potential money that you tried to save. Now, here's something else. Consumer use tax. It's not always about paying tax. Sometimes it's about not paying the tax. If you have a good process in place, they can also spot invoices where tax should not have been charged and was. And then you actually should short pay the invoice or talk to your supplier about removing the tax. And Ellie, let's go to the last poll question.
Absolutely. That question should be up on everyone's screen right now. Are you joining us next week for part 5? Next week, we will be doing part 5 of the 7 pillars of a successful sales tax strategy on Thursday at the same time. We really hope that you can join us for as many of these parts of the series as you can make it for. If you can't, or if you missed some, please just send me a message. I can send you a link to the recording. And Mike, why don't we give everyone just a couple more seconds and we can close it out and move forward.
Okay. All right. So some common process problems, training of personnel. So there's a lot of turnover. As soon as you get someone trained, they get good at their job, and all of a sudden you get to start over again. So there's a lot of time in training personnel to do this. Sometimes you train them, and for whatever reason, they stop following your process. Taxability complexity. Some very smart people out there often don't get taxability. Information sharing. The person tasked with managing this process is often privy to just the purchase information. They may not have access to the other information they need in order to do their job efficiently or correctly even. So these are just some of the common process problems if you're doing this on your own. I want to do one last case study here before we open it up to questions. And, use tax is such a big issue. Some companies say, I don't even want to deal with use tax. And John Deere, a number of years ago, contacted all of their vendors and said they're no longer going to work with vendors that don't charge them sales tax. And we see this from time to time. John Deere, probably the biggest one that I've been involved with. We got a lot of calls, people saying, hey, can they do this? Can they say I have to charge them sales tax even if I don't have Nexus? Yeah. That's a contractual issue. If they say you got to charge them sales tax, if you want to continue doing business with them, you got to charge them sales tax. So we assumed it was because of the use tax issues they were having. We got many calls asking if they should register to collect, and this was pre-Wayfair, so this was a much bigger issue pre-Wayfair, but it still happens today. And our advice was look at the percentage of business Deere represented. For some people, it was 30, 40, 50%. And to me, that's a no-brainer. Get registered, start charging the sales tax. Some companies said that, hey, they're like a 0.5% of our business, and we think that this is going to hurt our business with other companies. And I said, well, if that's the case, don't do it and see if they continue doing business with you or not. The more important you are to them, the more likely they are to make an exception. They didn't make very many exceptions at all. It was just such a headache. So you may see more and more of this. You may decide to do this. It's a lot easier to pay someone else sales tax and let them get it remitted than for you to self-assess and try to get it remitted to the state yourself. And at this point, Ellie, we have any questions?
We don't. Is there anything else you'd like to cover quick?
No, not a whole. I could talk for hours and hours and hours on use tax, but with only an hour to talk, we have to pick and choose. If anyone does have more questions after the fact, just shoot us an email. If it's something easy, we'll go ahead and answer in an email. If you'd like to speak to one of our salespeople about potential use tax solutions, by all means, do that also. You can contact at Sales Tax and More, the email up on the screen there. And other than that, I just want to thank everyone for joining us today. I hope that this has been informational, and we hope to see you at future webinars. Thank you, everyone. Bye-bye.